Right, hello, hi. Um, First of all, I actually thought that well, this is task 3, and I'm just going to go through this using the answers. Task 3, um, part 1. And I actually had made this video earlier on, but it didn't come out clear. So I'm just going to go through this and highlight a few things here. So I'm looking at the answers straight away, but I'm going to go through it here. Here they're talking about rental income, prepaid income, right? Prepaid income. So you owe this money. Let's see how we arrive here. So let's give a classic scenario. We have a scenario where you are a landlord and you have received let me just get my pen here. So we have a scenario here where you have received some rent from a tenant, and you should have received 10,000, but the tenant sent you a check of 12 for income. You received 12,430. Now you only should have received 10,000. So I'm going to change my pen color now. You should just have received 10,000. And if you were just supposed to receive 10,000, that's the only thing that should have gone to the statement of profit and loss, 10,000. So we know that 10,000 will come out of here into the statement of profit and loss, as in rental income. That means that the tenant has paid you 2,432 March. So we have a prepayment of income. It's a liability. So here we have 2,430. Right? That's what this is. That's what this initial amount here is, and I'll tell you how we get here. Remember that we transfer this. This gets this closes out for the year, and then we're done. And then the following year, when we have rental income, we reverse this. We start the year by transferring this, if you like, and writing rental income here, 2,430, and this is reversal. 2,430. What does that mean? This means that this tenant already has 2,430 towards what they owe us in this next year. So when this tenant pays us money through the bank, so when he sends us a check of something, we go debit bank and credit this. Well, they only really should pay us, if you like, if it's 10,000 every year, they only really should pay us 7570, for example. So we can then again just transfer 10,000 to the statement of profit and loss for the next year. Rental income 10,000. My point is that at the beginning of the year, this is a liability, right? This is a liability. That's the issue here. So what then happens? It then says that you have a scenario where I believe that you must have sent a check. You receive. This is what you receive. It says you receive 2,550 from this tenant again. So it's debit bank and credit this amount here, and that's what we have here. Then it says that the tenant again had prepaid some income again, and they tell you the amount they've prepaid. So again, we need to debit, if you like, this rental income account, and to credit, if you like, this prepaid income again. So the double entry here is 27, if you like, yes, 2720 in your rental income account, and credit your prepaid income account again of 2720. Right, the tenant, this 2720 is coming out of this amount. The tenant has paid too much, so this figure here relates to this amount that they have paid. They've paid too much again, and so we need to remove it, which means the only amount that's transferred to the income statement is that amount. Right, and this is rental income. When you watch the video 2 or the part 2, you'll see me dealing with an expense example, but this is to do with income. But just follow the double entry through. Right, again, almost to make it manual. Someone's paid you 2,430 of their towards what they owe you. Then they send you another check of 2,550. So literally now they've paid you all of this is what they have towards this year, this new year, because this came from last year into this year. Towards this year, then they pay you this again, and then they find out that they've paid you too much, 2,720. So we need to take this away from these two. So imagine this was covering the first 2 months of the year, and imagine they now pay you this, but this doesn't cover 10, this covers 11, right? We only want 12, so they've covered 2 from the previous year. Then they pay you for 11, but we only want for 10. They paid for 11, so take out this extra month, if you like, is one way of looking at it. So let's look at the next bit then, and the next bit says, how does this affect these things? Well, it doesn't affect assets because we're talking about the fact that this is a liability. Once you reverse that liability, right? Well, once you reverse that liability, because once upon a time you had a liability, right? Prepaid income. I told you, I'm saying this is a liability. Once you reverse this liability, once you take the 2430 out of here and put it in your rental income, you reduce the liability straight away. So the liability disappears. That's why this decreases, if you like. And in terms of your capital increasing, yeah, I mean, I imagine that because this is rental income. See, I'm just trying to see. This is a really dud one. I really can't see. A is equal. I think it's just purely for the accounting equation. They're talking about this here. D. So when it comes out of L here, it says that you have received some money here. So L goes down and the credit side of I goes up. Well, yeah, so that therefore if I goes up, that ultimately we end up increasing capital because we have I minus E adding on to C. But really this is I mean personally I almost feel this is flawed. There's no direct effect on capital really by this transaction. Really it's pretty much just affecting L and I, if you like, so to speak. But I can see the argument of how this pushes on to C. And of course, this is the very date that, because this happens this reversal happens at the beginning of the year, doesn't it? This reversal happens at the beginning of the financial year, so it's the 1st of April. Right, great. So that's part 1 to this question.